Have you been seeing these headlines lately? AI at all-time highs again. Nvidia's market cap breaking through the roof. Your 401k glowing green. You think you finally caught the wealth train. But today, I'm taking you higher to look at the other side of this AI party. Because when everyone's rushing forward, real money is quietly flowing in the opposite direction. Let me hit you with some numbers. Over the past 2 years, AI has pushed the Nasdaq up over 50%. Nvidia alone was worth more than the entire German stock market at one point. 7 tech giants account for almost all of the S&P 500's gains. But behind this AI wealth creation myth, there's a question you might have missed. Who's selling you those shares? These 7 companies, Nvidia, Apple, Microsoft, Google, Meta, Tesla, Amazon. They share one name, winner takes all. But the other side of that coin is everyone else loses. According to Bank of America Securities, AI investment has become the single most important engine of U.S. GDP growth. In other words, the center of gravity of U.S. economic growth is in the hands of a few tech companies. That's not diversification, that's hyperconcentration. And hyperconcentration means high risk. Now, here's the crucial part. When everyone's rushing in the same direction, who's quietly heading the opposite way? Just this month, Bank of America released its June 2026 Global Fund Manager Survey. They surveyed 198 fund managers managing $540 billion in assets. The result? 80% of fund managers said long semiconductors is the most crowded trade in history. That's the highest percentage in the survey's history. What does that mean? The smartest people on Wall Street are collectively telling you this trade is too crowded. But here's the interesting part. The same group of fund managers are reducing their positions. The BOFA survey showed tech overweight dropped from 50% to 38%. Meanwhile, cash holdings rose to 4.1%. In other words, they say AI is great with their mouths, but they're selling with their hands. This isn't bearish, this is risk management. They're not bearish on AI. They're just saying it's rallied this much, let me take some profits off the table. But here's the question. When institutions start retreating and retail investors are still piling in, who do you think ends up standing at the top of the mountain? Now, here's where it gets even more complicated. AI isn't just changing the stock market, it's changing central bank decision making. You've heard inflation comes from oil, rent, wages. But now, inflation has a new source, AI data centers. A striking comparison. During the dot-com bubble, IT investment as a share of GDP peaked at around 4.5%. Some research reports pinpoint it at 4.91%. Today, the AI capital spending of just the top 5 cloud providers has already reached that level. In other words, the intensity of AI infrastructure investment has reached dot-com bubble levels. Back then, the Nasdaq fell 78% and countless people lost everything. History doesn't repeat, but it often rhymes. In June this year, the Fed made a striking adjustment. They raised their core PCE inflation forecast from 2.7% to 3.3%. Why? One major reason massive AI infrastructure investment is pushing up overall price levels. Building data centers requires steel, copper, electricity, chips. These demands are driving up raw material prices, which in turn pushes up everything. More surprisingly, in March, the Fed's dot plot showed 0 officials predicting a rate hike in 2026. But by June, 9 officials said at least 1 rate hike is needed by year-end. 1 expects a cumulative 75 basis points, 5 expect 50, 3 expect 25. What does that mean? It means driven by the AI boom, the Fed may be back on the rate hike path. And rate hikes mean all asset prices get repriced. This isn't just about the Fed. The ECB restarted hikes in June. The BOJ raised rates to 1%, the highest since 1995. And the BOE is preparing to follow. Central banks globally are pivoting in unison, and the death of rate cut expectations means Borrowing gets more expensive, debt repayments rise, and stock market valuations need to be recalculated. Here's a harsh financial rule you might not have heard. Rate hikes are the natural enemy of growth stocks. The reason is simple. Growth stock valuations rely heavily on future money. When rates are low, future earnings discounted to today are worth a lot. When rates rise, future money is worth less. In 2022, when the Fed hiked rates, Netflix fell 75%, Meta fell 70%, Snap fell 90%. Now, if the Fed really restarts rate hikes, what do you think happens to AI stocks valued even higher than back then? If you think this time is different, let me show you a historical comparison. In March 2000, the Nasdaq peaked at 5,048. The most popular saying at the time was, "We're entering a new economy era. The old rules don't apply." Tech analysts invented all kinds of new valuation methods: eyeball valuation, click-through valuation, user count valuation. Sound familiar? Today, we're using AI computing power valuation, LLM parameter valuation, data scale valuation. History doesn't repeat, but it always rhymes. In March 2000, the Nasdaq hit 5,048, the peak of the bubble. Over the next 2 years, it fell to 1,139, a 78% drop. Amazon fell from $106 to $6, a 94% loss. Cisco fell from $82 to $8, a 90% loss. Not one company, almost every tech company. And these companies, most of them are still alive today, some even thriving. But investors who bought at the peak took an average of 7 years to break even. 7 years. Are you willing to wait? Of course, today's AI companies have real technology, real demand, real revenue. That's completely different from many companies in 2000 that had only PowerPoints. But the mechanism of bubble formation has nothing to do with whether the technology is real. Bubbles form when price diverges far from value. When a company's valuation already reflects 15 years of future growth, it doesn't need to be a fraud to be a disaster. Next, a perspective you won't see in financial news: who's actually making money from AI. Not retail investors, not pension funds, not even most fund managers. The real winners are early investors, venture capital funds, and founding teams who got in before the valuation explosion. How do they do it? 3 steps. 1. Buy low when AI was just a concept. 2. Use media and investment banks to push valuations higher. 3. Sell high at IPO to you. Let's look at the numbers. According to publicly disclosed SEC filings, in 2025 alone, AI-related company executives and early investors cashed out over $50 billion combined. Where did that $50 billion come from? From the public markets, from your 401k, your pension fund, your stock account. If these insiders truly believed valuations would double, why are they selling? There are usually 3 reasons insiders sell. 1. Diversification. Their wealth is too concentrated in one company. They need to spread risk that's reasonable. 2. Locking in profits. They've already made 10x, 50x, 100x on paper, turning some into cash that's rational. 3. And this is the one you should pay attention to. They might actually believe valuations are high enough. When a CEO sells at $800 a share, he's not trying to time the top. He's just saying, this price feels about right. The question is, you buying at $800 and him selling at $800, who's right? What are AI companies really worth? This is the most difficult question Wall Street is facing right now. Traditional valuation methods, P over E, P over S, DCF all break when applied to AI companies. Why? Because many AI companies are still in the burning cash for growth phase. Revenue is growing, but losses are growing too. You can't use P over E to value a company that doesn't have earnings. So the market is forced to use new methods: P over S, user growth multiples, computing power valuation. But these methods all share one problem: they have nothing to do with profitability. And valuations not tied to profits eventually face a reckoning. Every time a new technology emerges, The market invents new valuation narratives. During the 2000 dot-com bubble, it was eyeball count. During the 2010 social media boom, it was user growth. Today's AI story is computing power scale. But every time, when the bubble bursts, valuation ultimately returns to the oldest formula, free cash flow. How much money does this company actually make every year? What's left after all expenses? That's the ultimate anchor. The problem is, in the frenzy of a bubble, nobody wants to hear that old, boring story. Before we wrap up, I need to tell you the 3 cognitive errors retail investors make most often in this AI frenzy. 1. Confusing a trend with your own ability. AI is indeed changing the world, but that doesn't mean you'll make money from AI stocks. 2. Confusing short-term volatility with long-term trends. You see a pullback and rush in to buy, you might just be catching a falling knife. 3. Confusing media narratives with investment logic. Financial media needs stories, your 401k needs returns. They are completely different. Behavioral finance tells us that the investor's biggest enemy is often not the market, it's your own brain. FOMO, fear of missing out, makes you chase at the top. Overconfidence makes you think you're smarter than the market. Confirmation bias makes you only see information that supports your purchase, ignoring all risk signals. These 3 road signs are leading countless retail investors in the same direction to the top of the mountain. But here's the good news. Cognitive errors can be corrected. Now, you've seen what most people don't see. Next, Gino's 3 rules will show you how not to be the last one standing at the top of this AI mountain. So here's the question. When an AI bull market runs into a rate hike cycle, whose bubble bursts first? Next up, something you might be going through right now. AI giants are going public. OpenAI, Anthropic, XAI names you're probably familiar with. They're preparing IPOs. You might be thinking, great, I can finally invest in AI. But here's the question. Why are they going public now? Early investors, venture capital, private equity, founding teams have poured hundreds of billions into AI over the past decade. Now they need to exit. The only way out? Sell those shares to you retail investors and pension funds. This isn't a conspiracy, it's the rule of the game. But the question is, are you the one catching the falling knife or the one getting on the train? According to JPMorgan and multiple other institutions, AI-related capital expenditures by the top 5 U.S. cloud service providers are projected to exceed $750 billion in 2026, and that's just 5 companies. JPMorgan's report also clearly states if AI investment returns disappoint, these capital expenditures could be at risk. In other words, the hot trend you're chasing in the stock market might not even pay off. From its peak in March 2000 until October 2002, the Nasdaq fell 78% as the dot-com bubble burst. The new economy story back then and today's AI revolution sound almost identical. Technology changes the world, but technology changing the world and investors making money are 2 different things. All right, enough anxiety. Now here are 3 rules for you not to predict the future, but to make sure you're not the last one standing at the top of the mountain. Rule 1. Anchor to valuation. Don't get swept away by narratives. What's a valuation anchor? It's how much money a company makes, how long it's made it, and how stable it is. When the dot-com bubble burst, countless companies had grand narratives and millions of users, but no profits. Same in AI. Some companies are already priced for a decade of growth. If that growth doesn't materialize, prices collapse. Remember, buying stories is gambling. Buying earnings is investing. Rule 2. Watch cash flow, not stock price. Stock prices are voting machines. They reflect market sentiment, fear, and greed. But cash flow is a weighing machine. It reflects real value. When you see an AI company stock soaring, ask 3 questions. Is it real money or paper profits? Where does the money come from? If funding stopped tomorrow, how long could it survive? If you can't answer that money isn't yours to make, Rule 3. Watch the shovel sellers, not the gold diggers. In the AI gold rush, the people who actually made money weren't the gold diggers. They were the ones selling shovels, water, and jeans. In today's AI world, who are the shovel sellers? Companies providing data centers, chips, power grids, cooling systems. No matter who wins, infrastructure always gets paid. Watch them, but still mind the valuation. 3 rules. Anchor to valuation, watch cash flow, focus on infrastructure, not complicated but potentially life-saving. AI is an opportunity, but opportunities only belong to those who stay awake. Don't let greed destroy your principle. Like and follow. See you next time.